Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Masterclass. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at passiveinvesting.com. And I am so excited you're here. We do this masterclass live every Tuesday to help you learn the ins and outs of passive investing so you can go into your next deal with confidence. So if you haven't done so already, make sure to check out passiveinvestingwithwhitney.com. There you can get some free goodies, checklist, ebook, and everything to help you underwrite your next passive investing deal, as well as you can get access to our open deals that we currently have here at passiveinvesting.com. And if you'd like to, you'll have access to my calendar and we can jump on a one-on-one call so I get to know you better and we can understand how we can help you here at passiveinvesting.com meet your investing goals. Now, this week, I'm so excited to be joined by Brody, our Director of Finance. She is with us here today to help us demystify the K-1. Guys, we did a similar webinar last year, but I thought it was amazing for us to bring Tal back because we broke the internet on that episode last year.
We did. We sure did.
So Tal, I know we are in the middle of tax season. Your time is so precious. We got to get you back to working in the finance department right now. But I am so excited that you're here with us today. Tal, just take a minute or so and tell our investors, what you do here at passiveinvesting.com. And yeah, let's just kick it off there.
Yeah. So Whitney, thanks for having me. Again, my name is Brody. I'm the Director of Finance for passiveinvesting.com. I joined passiveinvesting.com in January of 2022. So now this is my third tax season. It does get better with time. We've established great relationships with our tax preparers. And even though we are growing and taking in more investors and issuing more K-1s, it has gotten to be a smoother process since my first year with them. Just a little background on me. I started my career with Deloitte & Touche. I was on the audit side, not the tax side, but I was always very heavily involved in testing the tax controls for public companies. So I've always been exposed to taxes. It's always been an interesting wheelhouse of mine. And I was asking Whitney, I was like, why do another masterclass on the same topic I did last year? And really, we only talk about taxes once a year. So a refresh never hurts anyone. And the more you see it, the more you're exposed to it, the better you can feel more comfortable in doing it on your own and understanding the material. So, yep, that's a little bit about me. I guess I'll tell you what I do at passiveinvesting.com. So I oversee all the accounting, the taxes, the finances. We've really grown our team out. So we do outsource some of our property management to third parties, and they will do all the day-to-day financial reporting. And then we do that for our car washes in-house. And then my team will just do some cash management, review the financials. And then from a tax perspective, we gather all the information all the way from forming the entity and preparing the investor rosters to issuing the financial statements and working through with the tax team all of their questions and everything up until we finalize those returns.
Awesome. And, for those people who have yet to invest in a passive deal, I know so many investors that I speak with, they were like, well, what does the finance department really do? Like, what's the added benefit? Don't they just get the cash from the property manager and then they distribute it to the investor? Guys, if you just heard that list that Tao just mentioned, they do so much more. They handle everything end to end, including compliance, right?
Mm-hmm.
On behalf of the investor. So it's super powerful, especially if you have a higher and better use of your time doing something else. I mean, maybe you're a high income earner, maybe you own a business, maybe you're a practitioner like a doctor, lawyer, engineer, high tech worker, maybe or just a parent, right? If you have a higher and better use of your time, leave this part to the professionals. Now, I want to put a little disclaimer here. When we say taxes, we're not training you how to file your own tax return. That's not the point here. We wanted to bring Tao back on to help you understand specifically the K-1. That way you can read it and then hand it over to your tax professionals to help you understand your tax situation and how you should file. So, Tal, let's dive in a little bit. What tax documents do the investors get during the tax season?
Yeah, so we're preparing the 1065, the tax return for a partnership. And as most of you know, a partnership is a pass-through entity. So in an effort to allocate all of the income, the losses, your distributions to the individual partners, we issue that in the form of a K-1. So after the end of every year, after we file those returns around March 15th, we will issue you those K-1s, and then you will use that K-1 when you file your personal 1040 or whatever tax return is related to the entity you're investing through.
Awesome. Okay. And then, sometimes in that K-1, there's a package. So there's the K-1, and then sometimes we have state documents. What is the investor to do with those state documents?
Take the whole package and give it to your CPA, but the state documents are important. So you will receive a state K-1 for the state that the entity is based in, so where the income is flowing from. Even if you don't have income, so as in you don't have to pay tax that year because it might be the year one of acquisition, so you're allocated all of this bonus depreciation and it's showing a loss. Make sure you check with your CPA to understand that state's filing requirement, because it might be in your best interest to file the state K-1, even though no taxes due, just to go ahead and absorb that passive loss that you will be entitled to either in year one or when you dispose of that asset.
I think that is so important. You have to work with a tax professional, to make sure you have the right documents filed at the right time. Now, Tao, I know you have an example of a K-1. Can we run through that really quickly? And then I've got a
Absolutely.
couple follow-up questions for you.
Absolutely. Okay, I'm going to share my screen.
All right. I can see it on my end.
Great. Okay, just before we get dig into the K-1s, this is just the overall tax return due dates. So as you can see, the partnership and S Corp tax returns are due on March 15th with an extended due date of September 16th, whereas the individual single member LLC and the C Corp returns are due on April 15th with an extended deadline of October 15th. So just basic information. A little disclaimer, Whitney's already said this, but this is just an introductory section to understanding your K-1. I'm not a tax specialist. The IRS rules are constantly changing, and always consult a professional on tax strategy. So Whitney, you already flew through all this. I didn't even need my slideshow.
Well,
Okay.
for the example, do you have an example of a K-1 in here?
Yep, I sure do.
Awesome.
Okay, so the way I have this structured is the K-1 is here on the screen, and then I'll dive into each part with a little bit more detail. So this is a K-1 from 2022, but it has not changed significantly since last year. So we'll start with part one. It's the section in red. And this section is important just because step one is making sure you recognize the entity that's issuing you the K-1. So that could be two things could be happening if you don't recognize the entity. One, you may not be a partner in the entity. It could be poor paperwork on the owner's ends. Two, you might refer to the property by the street name. So like the name that a renter would go into his or her home and rent a property. So the street name, whereas the legal entity that we form to raise the capital and purchase the property might be in a different format. So typically you're going to see our legal entity names won't align with the street name. It is typically some combination of letters and numbers. So that legal entity name should be in the PPM, so you can reference back there, or you can always reach out to the owner, operator, or syndicator for that information. So again, if it's an error, please reach out immediately. And the common reoccurring theme you'll see throughout these slides is the sooner you recognize an error and relay it back to the owner, the better. And the more likely it can be fixed in the current tax year as opposed to in the subsequent tax year.
Now, remember, we asked all our investors back at the end of November, beginning of December, to check their profiles in their investor portal. This is why we do it, because there is a very narrow window here in March when the K-1s hit and we're filing the final return for us to make any sort of adjustments. We want to eliminate that window if we possibly can.
Right.
Also, if you're looking to match up names, here's a little trick, guys. Look at your PPM, because your PPM, well, the offering memorandum has the street name, like you say, and then the PPM will actually have the LLC name that should be reflected on this tax return.
Exactly. Thanks, Whitney. So you kind of jumped ahead of me a little bit, but part 2 of the K-1 is the partner's information. So that is the email that we sent back in November that says, please sign on to IMS. Make sure that the investing entity is as you had intended it to be. Sometimes people will fill out a PPM in haste and maybe they filled it out in their individual name, but they meant to invest through a partnership. So just double check that information, because how it is presented in your investor portal is how it is presented in the cap table, which is what flows through to the investor roster to be fed into the tax software. So step 1, make sure that the input information is correct, because as we always say, garbage in, garbage out. So part 2 is so when we get the tax returns, we do review a good chunk of every single K-1s. However, some of our partnerships have 300 plus K-1s. So we might take more of a sampling approach and we might look at 60 K-1s. We will do our best to verify the partner's individual information. However, ultimately that onus passes through to the partner. So once you receive the K-1, make sure the address is correct, make sure the social security number is correct, make sure your name is correct. Really, that is your responsibility to receive the K-1, review that information as quickly as possible. So if there are any mistakes, either due to our own fault or inputting the information incorrectly on the front end, we can get that addressed for you as quickly as possible. The most common issues we see are typically just an incorrect name or address. That's not going to have any impact to your tax liability. So if you've missed the window to let us know, we'll say, we'll fix it next year for you. Doesn't impact your tax liability. Another common issue we see is that you might have invested through an IRA, but you're missing your custodian's name. So typically you'll see the custodian name for benefit of the benefactor or the investing party. That being said, if you're investing through an IRA, you should be using your EIN for your custodian. And something that I have seen this year, which is new, is that the tax software seems to be pushing these diagnostics that says, hey, you've identified this partner as an IRA by using this code, but the tax ID number is in the form of a social security number. So like track down the EIN number. So we have been able to go through, and while we've asked our investors to provide that, I can't say that it is always the information that is fed to us, but we've been more proactive in saying, hey, you've invested through an IRA, please provide the custodian's EIN rather than your social security number. Other common issues could be a domestic partner with a foreign address. It's not a big deal, but it's just a red flag. So if you are a domestic partner, you have a US EIN number, try to include a domestic address too. It's just a red flag that alerts through the tax filing process if it is a foreign address, because then it leads a reviewer to believe that it might be a foreign partner rather than domestic. Next would be the single member LLCs. I think we've really harped on this significantly the last few years, but as a reminder, a single member LLC, it rolls up to an ultimate beneficial owner. So it's a pass-through entity. So in this section of the K-1, in Part E, you're going to see the ultimate beneficial owner's social security number, not the EIN for the single member LLC. If you look down below to H2, that's where it says, is this partner a disregarded entity? And that's where you would fill out the single member LLC's tax ID number and the single member LLC's name. So I think we all have a good grasp of that by now, but it has been a point of confusion over the last few years. And then lastly, if it's a retirement plan, just make sure that checkbox is checked in I-2. Yeah, so those are the common issues I've seen. Whitney, do you want to add any more here?
No, I think it's great. And for I'll just say, if we get any questions about beneficial owner information and the Corporate Transparency Act compliance, we will be doing an educational webinar on that in April. We have plenty of time to tap into that, what you might want to be looking out for there, but that does not impact the tax season.
Next is this part 2. It's part 2 continued, the partner share of profit, loss, and capital. The beginning and ending percentages. So this is generally based on the partnership agreement, and it's typically consistent year over year. There are exceptions. For example, your beginning balance should agree to your ending balance. So if it doesn't, that could be a cue up, just a sign to do some digging. But then if your ending balance for the current year doesn't agree to the beginning balance, there may have been activity during the year. So for example, contributions, so additional capital was contributed to the partnership during the year, or redemptions that were made during the year. So that would have an impact, a direct impact on your ending percentages. Another reason this may change is if you were to assign your interest to another partner during the year. So the way that we typically display this on our K-1s is if you were to assign your interest from the assignor to the assignee during the current tax year, you would be provided with 2 K-1s. So the original K-1 would agree back to the prior year K-1, and then ultimately it would be zeroed out to show your capital balance would be 0. Your ending percentages may be 0. I've also seen them just stay the same. And then on your second K-1 for the year, that would be where we have reallocated your capital balance to the assignee, and then your ending balance should reflect what your current stake is in that partnership. Yeah, that's all I have for that section. Anything else?
No, I think that's great.
Okay. Next is the section that we really won't dive into too much. It's the partner share of liabilities. This is where we report the partner share of the partnership's liabilities. So if you have a negative capital balance, this is a section that your CPA would use to determine your basis, and the adjusted basis could be calculated using all 3 of the amounts. Really no need to dive into this in too much detail. This next section is very important. This is your capital account roll forward. So this will show the activity that is related to the current tax year. So in year 1, your beginning capital account balance would be 0. That's where you start. Then we would add any capital contributions, so the investments that you made during that year. Then you would add or subtract any partner's share of the current year income or loss. And then you would back out any withdrawals or distributions, which could be in the form of like a monthly distribution or even a redemption of capital. And then typically you're going to see losses for especially multifamily and storage in the first few years. Just a reminder that these losses are primarily driven by bonus depreciation, and they're not a direct reflection of the asset's performance. So, yeah, and I'm going to dig into the sunsetting of the bonus depreciation a little bit later in the new tax legislation that is going through the Senate's review now. So just one more point on this is the CPAs should be tracking your losses on Form 8582, all your passive losses. However, if you were to change CPA firms or maybe you're preparing your own tax returns now and you start using a CPA firm, I can't recommend enough how important it is to keep track of all of your losses through the life of an investment. So simple spreadsheet in Excel. Start with year 1, include your capital invested, include all the activity that occurred through the year, and just keep track of those losses, because you might not be able to take all of the losses in year 1 that you could potentially use in subsequent years. So it's just important to keep that summary for yourself. All right, now we're going to go through all these other red boxes in part 3, which is the income section. So typically you're going to see multifamily rental income reported in box 2. That's the net rental real estate income or loss, the passive loss. However, for our car washes, given they are operating entities, you would see the income allocated or the loss allocated to box 1 as ordinary business income. Another exception would be if you are a real estate professional and you materially participated in the activity, then that would not be a passive loss. It would be an ordinary loss for you. So real estate professionals require you to meet both of the following conditions in section 469. More than half of the personal services you performed in trade or business were performed in real property trades or businesses in which you materially participated, and you performed more than 750 hours of service in real property trades or business in which you materially participated. So this is subject to discretion. I recommend you work through those requirements with your CPA and a professional to determine whether you are a real estate professional.
Mm-hmm. Very important. Yes. Work with your CPA. They're going to give you the right documentation, checklist in order to meet that particular real estate professional status. You got to log your hours, guys.
Yeah, very important. Okay, next is just the net income loss allocation. So just to give you some additional insight into like where that number is getting pulled from. In our 1065, there's a form 8825. I don't know if you can see it big enough on my screen, but it basically goes through all of the different types of income and expenses that are related to the property. So the tax firm will prepare this based on our financials, and then based on the income, that's how we allocate it back to the partners. So gross rents less all the rental real estate expenses, including depreciation and interest. Then we carry forward that amount into the form 1065, net that against any other types of income or loss, such as ordinary business income, interest income, gains, losses. And then the partners would be taxed on that net income, or they might be receiving losses of the partnership. And just another clarification here, regardless of whether or not the income is actually distributed to you as the partner, you may be subject to tax. Part 3 continued. This is the distribution section. This is where you would see any distributions made to you throughout the year. Typically, you're going to see the partnership agreements include a distribution based on a preferred return, which would be calculated using the partner's unreturned capital balance times that stated preferred return rate. The form of the distribution will determine the tax treatment. It can totally vary by investment class. You may have elected to invest in an investment with several different types of classes with different types of preferred return. So you could be invested in several classes and have different treatment depending on the nature of the distribution sent for that class. Primarily, you're going to see 2 types of distributions. Capital distribution, which is decreasing the partner's capital account balance. So think back to that capital account roll forward we just saw. It would directly decrease that capital balance. And then a liquidating distribution would be at the time of sale, where or when you just dispose of the investment, where we would zero out the capital account balance entirely and your equity interest and issue that final K-1. This section, other, you'll see footnotes here with codes. I've put the standard other type codes that we typically see in our returns related to interest income. And just for reference, if you look at the instructions of a K-1, it'll have all these codes listed with a description for each. So you can always check there if you need more information. Business interest expense, which is code N, to report your share of the partnership's deductible business interest expense to compute the basis limitation. The qualified income business deductions, which is code Z, Generally, you're allowed a deduction of up to 20% of your net QBI. Your CPA would then report that information on Form 8995. And then any additional relevant information pertaining to Section 199A may be included in a footnote. We do our best to always footnote all these codes so that you have the additional information needed for your CPA if it is applicable to you. And then lastly, Code V, which is the unrelated business taxable income, which is used by tax exempt partners to determine the amount of income that may be subject to tax based on your debt leverage. Again, always consult your CPA on these just to make sure you're applying them appropriately.
So a couple quick questions here. If somebody sees the code STMT, what does that mean?
That sounds like statement. And so typically you would have a statement attached to your K-1.
Okay. And then if there's any sort of clawback at the time of sale, is that also noted in this box here?
It completely depends. It should be noted there, but it depends on the nature of it. And I guess also your tax preparer and how you've elected to disclose it on the K-1. It could depend.
Classic real estate answer, guys. It depends.
Sorry. Y'all
No.
know the drill. It's a
Sorry.
great world. Just a few reminders, and then also wanted to get into this tax legislation I talked about earlier. But if you're issued a final K-1, just make sure that final K-1 box is checked at the top. Again, also, if you're amending your K-1, then that other box could be applicable. Form K-2 and K-3, which was just released last year, those were released to provide greater clarity to partners on how to compute their U.S. income tax liability with respect to items of international tax relevance. If applicable, you will receive a K-3, and that checkbox will be checked. So bonus depreciation is currently sunsetting through 2026. That being said, the House did just pass new legislation, or a new bipartisan legislation called the Tax Relief for American Families and Workers Act of 2024. So the bill is now heading to the Senate. However, there's no way of knowing when the Senate will actually be reviewing and looking at this bill. I find it highly unlikely that it will occur before March 15th, which is the partnership tax filing due date. So at this time, we are preparing our returns based on the current legislation. Why is this relevant for you? It's because this new legislation includes proposed changes. So it will reinstate the 100% bonus depreciation deduction for qualified property placed in service after December 31st, 2022 and before January 1st, 2026. So that will affect bonus depreciation for tax year 2023 that we're preparing now. It's not as significant for a lot of properties. It is more significant for properties that were acquired during 2023. So all we can do right now is monitor it. We're not going to delay the delivery of our K-1s. We will file extensions when we do all of our filings, so that way we can supersede our partnership tax return, which is a lot faster and a lot less expensive. And I highly recommend that you as individuals consider taking the same approach. You can go ahead and file timely, but just in addition to filing timely, go ahead and file that extension. So if the Senate does pass this legislation and we do have to push through those changes to bonus depreciation, you can easily file a superseded return as opposed to filing an amended return, which is just typically more tedious and time consuming and expensive. So yeah, that's just an update on legislation. And then lastly, be aware of state compliance pertaining to K-1 filing requirements and treatment of bonus depreciation. Some states don't allow bonus depreciation. So typically, if we are operating in a state that doesn't allow bonus depreciation, then we would include a footnote that says this is what bonus depreciation is, just in case you are able to apply it to your return in other areas. And then, do I have any more slides? Last one. Okay, summary. Just verify your personal information is appropriately captured in the investor portal before tax season even starts. We send reminders out, we give you a deadline. After that deadline is closed, that's when we're pulling those investor rosters and getting them over to the tax teams for verification and import into their software. So just try to take that responsibility on the front end to prevent mistakes on the back end. Understand the tax prep and tax filing timeline, both from your own individual filing timeline needs and also from your syndicator owner's tax preparation needs. Once the K-1 is delivered, open it immediately. Simple, click it open, save it out, send it to your CPA immediately. Say, hey, just take a look at this, make sure it checks out. It would be an easy way for you to identify mistakes so we could quickly push them through and not hit that unfortunate scenario where we have to consider amending a return, which, like I just said, is costly and tedious to do. Consider any assignments of interest that occurred during the year. Again, like we discussed earlier, you'll likely receive 2 K-1s if you were to assign your interest, one for your original assigner and then, or the transferor, and then one for the transferee. And then lastly, use that K-1 to report your income or loss on your tax return. Again, we've touched on this before, but the amount of loss that you may claim may be less than the amount reported on your K-1, and it's your responsibility to consider and apply any applicable limitations. And just keep in mind that any losses that may not be allowed this year because of limitations could potentially be carried forward and deducted in later years. And again, reminder, keep track of your losses to ensure you're carrying them all forward and utilizing them to offset income as applicable in future years.
Awesome. Well, Tao, thank you so much. And we really appreciate your time, knowledge, and expertise today. Guys, I know several questions are coming in. Some of them are very personal. We're not going to be able to address those. Tao, I'm going to take just like 3, max 5 minutes. We're going to do some rapid fire here. Guys, I'm going to stay on. I will be happy to, answer anything that I can personally, but we need to get Tao back to tax prep season. All right, guys. Quick question. What is the statement? We mentioned STMT when we were talking about box 20. Do you have it, what is that actually saying? If somebody gets a statement, what is that including?
It completely depends. It could be some kind of roll forward. It could be a footnote that was too long for just a little blurb that needed additional expanding upon. It could be in a number of forms or variations. I would just say review that K-1 every single page to understand what that statement's related to or what was included. And if you can't figure it out, ask the syndicator, ask the owner, have them explain it to you.
Mm-hmm. And most importantly, I would say even first step, work with your tax provider to make sure that they have everything they need, right? Because they're gonna look at these forms, they read them every single day. They're gonna understand how to take all these boxes and use it. If you're doing this yourself, of course it's confusing. This is where tax professionals earn their weight in gold. Again,
Whitney, what do you always say if you have these passive investments, maybe you should consider using a CPA or outsourcing your tax prep? You always have something that's like, here's the sign that you should no longer be doing your own taxes.
I mean, honestly, like if you're doing syndications, I mean, you are investing in an operating business, leverage your time. That tax professional is going to earn their weight in gold. It's going to pay back. They're going to, it really, honestly, it just takes you mislogging your losses one time on one investment, and you could have paid, probably for, 20 years of, if you miss 50K of losses, you could have paid for 20 years of tax returns right there. And
unfortunately, you don't notice that until 7 years later when the property is sold, and then you're like, uh-oh, we forgot to file these in year 1.
I do a lot of private coaching. I see this all the time when investors do their own tax returns. Find a CPA. You don't have to pay $25,000 a year or even $2,000 a month. At least find a CPA to help you walk you through this. Okay. Real quick, can you speak to the 1099A tax deduction?
1099A, no.
Or not 1099. Okay. I'm going to try the numbers again. 199A tax deduction.
Okay, yeah, that's in the other income section, the Tax Cuts and Jobs Act. I really am not a subject matter expert on this, so I would say refer to the K-1 or the IRS website for additional information on that. It's just related to passing through business income to deduct up to 20% of the qualified business income. That's all I can say on it.
Okay. And then we have one person asking, if an investment has a clawback, are there certain boxes they should be looking at for the clawbacks?
I'm not going to touch on that one either. I was
Okay.
talking to a professional or a
Okay.
CPA. Yep.
So work with a professional, and if there is a clawback, also to ask the operator, right? Like, so here's the thing, is that we know how we would do it, but we can't speak to how other operators are doing it. So we could say, hey, if we had a clawback, this is where we're going to put it. But that doesn't mean that other operators are logging it that exact same way. So it's very important that if you feel that there is a clawback there, that you're working with your CPA to make sure that they understand where it is. And if it's not documented, that you're working with operator to make sure you get the right information. Tao, I know we've got other questions coming in. I'm going to take my best crack at them. Thank you
Okay.
so much for your time here today.
Yep.
Guys, all right, we're going to let you go.
Thank
Thank
you.
you. And we will see you soon.
Bye, Whitney. Thanks for having me. Bye,
Bye.
everyone.